It is the last market day of the month, and that means we have dividend raises to look at. So these are all the companies who rose their dividend over the course of the last month. And I love this, going through here, looking at some of the stocks that I own. Realty Income. I used to own Texas Instruments. Microsoft is definitely on my radar. And there is a lot of raises this month, a lot of pretty big ones, but we'll see if they're actually good raises long term for the company. If dividend investing is what you like to do, I do this every month. Please subscribe to the channel. Even if this is the only video series that you watch, it's great to stay on top of dividends are a very important metric for valuations here. We will get right into all of the companies that rose their dividends this month. Now, we're not going to go name by name and talk about them, but we're going to see what the best and worst raises were and see what's worth investing in on a dividend basis. So we only have a few that are green on their payout ratio. So we're looking for something that pays out 30 to 50% of their earnings. More than that, and they might be paying out a little bit too much. Less than that, and they have some room to grow it, but honestly, they're not really paying out enough to be a dividend stock. So the first good stock on this list is Microsoft, who came in with a 10.3% raise, bringing their payout ratio up to 30.77%. So they are now in that healthy dividend range of 30 to 50% at the lower end. So they definitely can continue with these huge jumps. And that's exactly what we're looking for dividend stocks. So Microsoft is for sure going to make the dividend list. I just this last week did a video on them for value, and they are a little pricey for the fundamentals of the company. 270 would probably be what we'd really want to look into buying into, but it does trade at a decent premium for the company that it is. Next, we have AGX, Argon Inc. I actually do not know much about this one, so I might have to look into it because they came in with a 20% raise, with raising their dividend from $1 to $1.20 a year, and that payout ratio is 45.57. So they're reaching the higher end, but still looks pretty good. Yielding 2.64%, so nothing crazy, but that's a good healthy dividend. Usually the 2 to 3% are where they're actually solid companies on top of paying a dividend. And then once you get higher than that, not the best companies, but they have enough cash flow that they can pay things out. Citi Holding Company, CHCO, 10% raise, bringing their payout ratio to 37.38%. Again, I need to look into this one and see, is it a decent value company too? Their yield is 3.17, so of the green companies this month, they're the highest yielding. And they're followed up by Accenture Public Limited Company, ticker ACN, who came in with a 15.18% raise, and that brought their payout ratio to 46.91. And finally, the other of our 5 very solid dividend companies this month is Crescent Capital BDC, ticker CCAP, 60% raise, bringing their payout ratio into the healthy range at 37.14. And they are yielding 1.87%. So that's a pretty low yield on that stock. So those are the top ones. Payout ratio is probably the best thing to look at this month because there's not a whole lot of those, but there is a whole lot of high rates. So we can sort this from largest to smallest and see who is in the danger zone. Here's that healthy range we just looked at. So below there, these ones could have some potential. Their payout ratio is low. As long as they're bringing in big raises, things could turn out fine, like this InterDigital Inc., IDCC. In the future, may be on our radar. If they come in with another 14% raise, that might push them up over 30% payout ratio. SLVM and SCVL both came in with 20% raises. They're pretty low. It might be 2 years, maybe 3 before they're within a good, healthy dividend range. But we could dig into the companies and see it's better for them to use that cash for operations. If they can get a decent return on invested capital, then an investor should prefer that they are not paying out the dividend, but rather reinvesting that money into the growth of the company. And then we have a series through here where it's just getting a little high with that payout ratio, not super crazy. When we hit the reds, those are the ones we're probably looking at cuts in the future. But Main Street Capital coming in with 19.57% raise, bringing their payout ratio to 74.79. I mean, that's a big raise and a big payout and a big yield. So it's definitely a strong dividend stock. Host Hotels and Resort, HST, 20%, bringing it to 69.43. So that, again, is another decent potential stock, but definitely exactly what we're looking for. We found in these down here. Now the danger zone. Some of these are a little different. Blue means it's a REIT. REITs have different accounting, so the important thing to look at there is the raise. Like Realty Income, they have a red raise, 0.2%, but they like to raise their dividend by half a cent, a full cent every few months. So they stack a bunch of these raises throughout the year, and they don't do it at one time like some of these companies do. So maybe at the year end, we'll see how much they actually rose it, but for now, that's fine. First Energy Corp, ticker FE, 5.13% raise, but they only made this last year 79 cents in earnings. Now, I was digging into it because I thought that looked a little weird. I guess typically they're around the $2 mark, so their trailing 12-month EPS was exceptionally low, and that's why this looks a little skewed. Maybe they'll be back on track this next year, and it'll be the $2 mark, and all of a sudden they will, at that point, be paying out 75% or so. WP Carry, very low raise, and they're in the danger zone. 354 EPS, but paying out a dividend of 428. So I would not bank on that dividend continuing. 7.92%, that's a yield trap if I've ever seen one. All of the signs. Lument Finance Trust here, 11.54% yield, moved up to 13.46. They made 14 cents EPS. They pay out 28 cents. Like, most of the time, this red here is a yield trap, and that's what we're seeing across the board. And that's why they're up here, is paying out 39 cents, making 47. There's not a whole lot left to reinvest into the company at that point. So, I mean, if you're investing in them, then it's probably just for the dividend, because there's probably not a whole lot of growth left in that company if they don't have the revenue to reinvest. Starbucks, I thought, was a little interesting. Maybe their EPS was just down over the last 12 months, but they came in with a 7.55% raise, a new dividend yield of 2.5%, but their payout ratio is $2.83. So definitely reaching those danger levels. I'm trying to pull up the financials and see if that was just a down year for earnings per share. Okay, their EPS is a little interesting. What I'm seeing is in 2020, 79 cents, 2021, $3.56, 2022, $2.85. Trailing 12 months, 283. So something strange is going on there. That'd be something that we'd have. And that's what we're looking at for this month. So I will slowly pan over everything so you can see, if you own any of these stocks, what's going on with them. and then we'll do a quick overview of the largest names. Shoe Carnival is not that big of a name. I know Verizon is a pretty big name. They came in with a less than 2% raise. That's not even beating inflation. And their payout ratio is 53.45%. With the amount of debt they have, it doesn't make sense for them to be raising their dividend, in fact, even paying it. So definitely not looking good there. And just recently did a comparison between Verizon and AT&T, and neither of them looked like they were worth investing in. Honeywell International, that's a pretty big name, especially when I was pretty heavy into dividends. I saw it come across pretty often. We prefer something above 5%. 4.85 is fine for a raise, and their payout ratio 54.15. So they're a little shy of the mark on the raise amount, and the payout ratio, they're a little high. So they might be an okay one. Texas Instruments, I know I used to own this one. I sold out of it. I did a video when I sold out of it. They came in just shy of 5% as well. Their payout ratio is higher, though, 62.45. So that is getting a little high up there. Keurig Dr. Pepper, 7.5%. So the raise was good, but 75% payout ratio. That's definitely starting to reach the danger zone where there's not a whole lot of margin of safety. It's either if there's a down year, they just lose money or they cut the dividend. And that's not something as an investor that you really want. There's a lot more margin of safety for the company when it's only 50%. And Vici, that's another one that I own. They are a REIT, so they should be paying out 90% of their earnings. And at that rate, they're only coming up with a 7.46%. So I wouldn't be surprised if they either came in with another raise this year, kind of like Realty Income does, or if they issue quite a few shares, because that's how the REIT space works, is especially if you want to hold your dividend stable. You can issue shares, get some money, go buy another property, raise your cash flows. It's not great for investors on a stock appreciation, but it's decent on the dividend side. We already talked about Starbucks. Philip Morris is another one that I know people really like. Raise came in a little low. It's just barely ahead of the target for inflation. In fact, that you're below water if you factor in the most recent inflation. And they're like basically paying out every single penny that comes in. And it looks like that is about everything. American Tower Corporation, I've heard quite a bit about. 3%, nothing huge. Payout ratio looks massive, but it could just be something funky with the numbers. It is a REIT, so we're not surprised when those come in high. So those were the raises for this month. Let me know if you own any of these stocks, if you're excited about your raise, what that does for your dividend income in the future. I know I can go and key stuff into my spreadsheets and say, this raise here, I own more than 100 shares of Vici, so all of a sudden I'm making 10 cents more per share. So it's an extra $10 a year off of that. And Realty Income, I mean, that was nothing crazy of a raise. It, again, is like half a cent or a quarter of a cent, whatever raise they do. But I'm pretty close to 100 shares on that as well. So getting up there where things are having a much larger impact. Overall, I think the winner for this is Microsoft, coming in with a really good raise, sitting at a really good payout ratio, especially since we just looked at it on the value front, and the balance sheet, the financials, everything just looks really good for that company. Just need to wait for it to hit the right price to buy in. And with that, I want to thank you guys for watching. Please subscribe so that you can know what companies raise their dividends next month. And I will catch you next time.